And now for more on the Fed's rate decision, we're joined today by Greg Buchak, professor of finance at the Stanford Graduate School of Business, Stanford University. Professor Buchak, thanks for coming on today.
Yeah, thanks for having me.
So this was Kevin Warsh's first policy meeting as Fed chair. What do you make of the Fed's rate decision?
So Kevin Warsh, he was just confirmed as Fed chair. He replaced Jerome Powell. Trump had kind of been fighting publicly with Powell really over a lot of these Fed rate decisions. So it's really interesting to see this. Powell's term expired. Warsh was Trump's picked, but he's sort of widely viewed as being very qualified, professional, very independent. And I kind of would expect, given the current situation that I think we'll get into in a little bit, he very well may break with the president's desire for lower rates. So his reputation is as an inflation hawk, meaning there's some expectation he'll be more aggressive at managing inflation. And with that said, today the Fed held rates steady. They targeted a range of 3.5% to 3.75%. And one of the things that Warsh emphasized was price stability, which suggests the Fed is going to be taking inflation very seriously in the coming months. And that's really what I was expecting, and I think that's sort of what the broader market was expecting too.
I see. 9 Fed members indicated they expect to raise interest rates by the end of the year. This is a significant change in sentiment from the Fed's previous projection, right?
That's right. So the Fed thinking is sort of trading off unemployment versus inflation. That's kind of the dual mandate that Chairman Warsh referenced in his remarks. Now, lower rates, they tend to spur investment, hiring, spending. They kind of make asset prices like stock prices or home prices increase. And higher rates do the opposite. So sort of the thinking at the Fed and among economists is when the labor market's weak, you want to lower rates. When inflation is too high, you want to raise rates to kind of cool things off. Now, like the unemployment situation is pretty good. There's a 4.3% unemployment rate. That's kind of on the lower side. There was recently a fairly positive jobs number in May. People have for a while kind of been waiting for the bottom to fall out of the US labor market, but so far it's kind of held on. On the other hand, inflation is too high. Okay, the Fed's kind of long-term target is around 2% year over year. And for the past few years, it's been stubbornly in this kind of 2.5% to 3% range. And actually, there have been market increases since March. And actually, the latest monthly number was 4.2% year over year. And that's really far outside of the Fed's target. And that kind of unambiguously calls for rate increases.
I see. And as for other major economies, Japan's central bank has increased its main interest rate to a new 31-year high following a surge in global energy prices. And this, comes after the European Central Bank raised rates last week. So what do these decisions suggest about the current state of the global economy, and how could they affect the Fed's decision moving forward?
Yeah, I think this really reflects kind of a global economy that's concerned about high energy prices, partly coming from what's going on in the Middle East. Energy prices are high worldwide, and it's kind of the natural central bank reaction to raise interest rates in response to that. Now, raising interest rates doesn't magically fix sort of the conflict in the Middle East, but it can clamp down on sort of energy demand in the short run and keep inflation from settling in. Again, sort of raising rates tends to reduce spending. If there's less energy that people can buy, then we want to make people want to buy less, and that will keep prices down. Now, the Japan thing, it's always sort of notable when Japan raises rates in particular. They famously spent something like 30 years at essentially 0% interest rates, and their breaking from that is pretty significant. Now, like as for how this impacts the Fed's decision, I would view this more as providing kind of external data to the Fed. The idea is that many countries are sort of concerned about higher prices. This suggests that the Fed should also be concerned about it. I think unlike a lot of smaller countries like Japan or Korea, the US doesn't really face a lot of pressure to follow or keep pace with other central banks' rate decisions. For a country like Korea, this is really important because interest rate differentials dramatically impact exchange rates, they impact currency flows. When you're a relatively small economy that relies a lot on exports, this is a huge deal for you. Now, and it really constrains what the central bank can do. That doesn't apply so much to the US because really the US is so large and so much trade is invoiced in US dollars anyway. Exposure to other countries' policy rates is a lot lower.
And all this comes as, the Trump administration announced details of the agreement to end the conflict with Iran. Many analysts expect that it's unlikely that oil and gas prices will return to pre-war levels for months, even if the Strait of Hormuz reopens. But could the deal still provide some relief for global energy markets?
Yeah, I think it's sort of going to reduce risk premia a little bit and provide some relief. Now, kind of broader context, oil prices peaked at about $100 per barrel. They haven't really been above this, and they've come down a lot, even as the conflict has been ongoing. And I think a question you could ask is, why haven't they been higher? Why haven't they increased as the conflict hasn't resolved? So I think first, countries like the US and China, they've been tapping into their strategic oil reserves. Okay, so the US just has a lot of oil that's saved up, and they can deploy oil from that to kind of dampen these supply shocks. Okay, so these reserves, they run out eventually, but so far they've been sort of keeping prices from getting really out of control. Second, I think it's important to remember people are super adaptable. There are other routes, either in the long run or the short run, to going through the strait. At a certain price point for oil, these alternate routes or alternate technologies for transferring oil become more feasible, and that's going to keep a lid on prices. Also, there's alternative sources of energy. Like, for example, I have an electric car, so I just haven't really felt this directly. People respond to these price incentives by sort of substituting away from really expensive routes or expensive energy. And then I think third, markets are already sort of pricing in an end to the conflict to some extent. So we're not going to see a huge oil price reaction as sort of things play out as people expect them to play out. Now, that's all to say, prices are still about $15 to $20 above their pre-conflict levels. I'd expect them to decline a little bit, but there probably isn't a ton of room for them to fall dramatically. I'll also just say, at this point, until we see the sort of the truce more established, I'm a little bit skeptical that this deal will really open the straits to shipping traffic in the long term. I think it a little bit remains to be seen whether it will hold or not.
I see. We'll have to see how that plays out. All right, Professor Buchak, thanks for coming on today. We appreciate it.
Yeah, thanks for having me. Take care.